Hello students, welcome to my YouTube channel all about economics. This video is created for the SYBCOM student who are preparing for the semester examination. Here I will discuss about some important broad essay type questions for the subject business economics. There are 4 chapters. First one money, second inflation, third trade cycle, and the fourth public finance. So let's start. Here the first question is what is meant by money and explain its various functions. Regarding money, definition given by Professor Walker. Money is what money does. Professor Crowther defined money as money is anything that generally acceptable as a means of exchange and which at the same time acts as a store of value. Here I'll just briefly explain the points regarding the functions of money. Functions of money can be divided into 3 parts: primary functions, secondary functions, and contingency functions. Primary functions includes that money acts as a medium of exchange, money acts as a unit of account. Secondary functions includes money acts as a means of store of values, money acts as a standard of deferred payment, and money acts as a means of transfer of values. Contingency functions of money includes that money serves as a basis for credit creation. It helps to distribute national income equally. It serves as a liquid wealth for the economy, and with the help of money we can maximize satisfaction. Next question is explain the process and limitations of multiple credit creation of commercial banks. There are many banks which involve in the process of credit creation. Credit creation by many banks for many purposes is called as multiple credit creation. With an example, we can explain the multiple credit creation of commercial banks. Assume that there are 4 banks like the SBI, Union Bank of India, Bank of Maharashtra, and Central Bank. Suppose, first of all, rupees 1 lakh is deposited in SBI. SBI will keep cash reserve ratio of rupees 10,000 and balance of rupees 90,000 will be granted as the amount of loan. SBI will credit the amount of loan 90,000 to the borrower's deposit account. Then the borrower will allowed to pay his obligation by issuing checks against that deposits of rupees 90,000. If the borrower's creditor has bank account with the Union Bank of India, then check issued by SBI customer will be deposited in Union Bank of India. Union Bank of India will make a loan of rupees 81,000 by keeping rupees 9,000 as cash reserve. If the Union Bank borrower issued check to his creditor having bank account with the Bank of Maharashtra, then there will be deposit with the Bank of Maharashtra and the amount will be rupees 81,000. Further, Bank of Maharashtra will keep rupees 8,100 as cash reserve and will grant loan amounting to rupees 72,900. If the borrower from Bank of Maharashtra issued check to his creditor who has a bank account with the Central Bank of India, then there will be a primary deposit with the Central Bank of India and the amount will be rupees 72,900. Again, the central bank will hold rupees 7,290 as cash reserve, and the balance amount of rupees 65,610 will be granted as a loan. This process will be continued till the amount of initial deposit gets exhausted. So this is the process of multiple credit creation of commercial banks. Limitations of multiple credit creation of commercial banks. Primary deposit must be there. Deposit multiplier is reciprocal of cash reserve. The higher the cash reserve to be kept, the smaller will be the credit creation. Cash drain is also one of the limitation. Credit creation is also depend upon the banking habits of the people, supply of collateral security, and the monetary policy of the central bank. Apart from this, that the business condition also uh, affect the credit creation of commercial banks. Next question is explain the credit control tools of RBI. Credit control tools of RBI are divided into two parts. One is quantitative credit control and the second one qualitative credit control. Quantitative credit control is a process of regulating the volume of credit money by the central bank of the country. It includes tools like bank rate policy, open market operation, variation in reserve requirement. The credit controls, those are designed to regulate the direction of credit, are known as qualitative credit controls. It includes margin requirements, regulation of consumer credit, rationing of credit, issues of directives, moral suasion, and direct action. Next question is explain the quantity theory of money. This theory is given by American economist Irving Fisher in his book The Purchasing Power of Money, which is published in 1911. In the words of Professor Irving Fisher, other things remaining unchanged as the quantity of money in circulation increases, the price level also increases in direct proportion. If the quantity of money is double, the price level will also be double and the value of money will be one half. On the other hand, if the quantity of money is reduced by one half, the price level will also be reduced by one half and the value of money will be double. This theory can be explained with the help of equation, also with an example and this diagram. Next important question is explain the meaning, causes and effects of inflation. Professor Crowther has defined inflation as a state in which the value of money is falling, that is, prices are rising. Causes of inflation can be divided into two parts: factor affecting demand and factor affecting supply. Effects or the consequences of inflation can be divided into three parts: effects on production, effects on income distribution, and other effects. Next important question is what is meant by trade cycle? Explain its various phases. According to Professor Keynes, a trade cycle is composed of good trade characterized by rising prices and low unemployment percentage, altering with the period of bad trade characterized by falling prices and high unemployment percentage. Phases which occurs in trade cycle: prosperity, recession, depression, revival, and again prosperity. Next question is explain the policies for to control trade cycle or business cycle. Monetary policy and the fiscal policy can be used. to control the fluctuation that arise in the trade cycle. Monetary policy is the process by which monetary authority of a country, generally a central bank, controls the supply of money in the economy by its various measures in order to maintain price stability and achieve high economic growth. And fiscal policy means it is the government policy regarding its revenue, taxation, expenditure, that is known as fiscal policy. Monetary policy includes regulation on legal tender currency, bank rates, open market operation, variation in reserve requirements, qualitative credit control measures. Fiscal policy includes taxation, public expenditure, public debt, built-in stabilizers. Next important question is what is meant by public finance? Explain its nature and scope. There are various definitions given by various economists on public finance. In the words of Dr. Dalton, public finance is one of those subjects which lie on the borderline between economics and politics. It is concerned with the income and expenditure of public authorities and with the adjustment of one to the other. The nature of public finance can be explained with the help of these points. Scope or subject matter of public finance can be explained with the help of these points like public revenue, public expenditure, public debt, financial administration, budgetary policies, fiscal policy, and fiscal federalism. Next important question is what is meant by public expenditure? Explain the causes of increasing public expenditure. Public expenditure is the expenditure incurred by public authorities, central, state, and local government for satisfying collective needs of the society and promoting the economic development and social welfare. These are the causes of increasing public expenditure. Thank you very much for watching this video. Don't forget to subscribe, like, and share my YouTube channel all about economics. Also check my YouTube playlist to watch more videos given for the SYBCOM class. Thank you.